I know people who are very high on this company because they think that the growth potential is outstanding. If we look at their earnings per share, you'll see that they had very good earnings per share, and they're going the wrong direction now. I don't follow this company, so I can't tell you why they had a bump in earnings. Who knows? You know what? If a company decides to take profits and put them in this quarter instead of that quarter, that will bump that number up. And they have all these type of games that they play, and that's why PE ratio is just one number to follow. And it's just if everything is equal between two companies, and one has a PE ratio of 30, another one has a PE ratio of 15, then obviously that's something that you need to be aware of. The one at 15 would initially, you would think it's a better deal, because that means the price to earnings is lower, okay? Which means that if it is a relative bargain at 15 instead of 30, and it goes up to 30, then you're going to make that amount of money. It is so difficult today because it really depends on good information. So when you see a price like this, obviously you wish you had jumped on board at this point. And this is the type of company where if you can identify these really good companies and jump on board, if you have confidence that they're going to be able to maintain it, whether you pay 80, because if Apple is the real deal here, then the chances are, unless something catastrophic happens, like what happened to Lumber Liquidators there, the price isn't coming back to 80 anytime soon. And so if you're able to get on board, then perhaps this will continue to $250. If the economy goes south and people can't afford to buy certain things, maybe Apple will suffer. With the price of oil being hammered in the last 6 months, how has it impacted their stock price? Well, you can see 6 months ago they were at around $105, $104, and it's been a steady decline. It's now down to 84. Now, if the price of oil goes back up, well, not if, but when, you can see that the price has definitely impacted them. Caught them a little bit Q3 and then last quarter. It's basically a 30% hit. And you can see where they've adjusted their numbers for Q1 and Q2. Q1, Q2 last year, they're up at $2.10, $2.05. Now they're saying less than half of that. Now, if you were a contrarian, you'd jump into this at a certain price that you think is fair, and that's where the PE ratio comes in, one of the factors. What's nice about this is it gives you a 5-year average. So right now, again, all things equal, it's lower than the industry average, but you could argue that the price is going to come down a little bit because, look at that, PE ratio of 30. Basically $30, I'm paying $30 for $1 of income for them, okay? Or with Apple, 14. Well, I think the potential for Apple is much greater. I don't know Lumber Liquidators, but based on flooring and with where construction is today and home sales, and forget about it. Apple has much better potential. Well, when you don't see a PE ratio, that means they're not making money. It means they're losing money. Or if earnings are negative, then you can't have a positive price for a PE ratio, right? So I'll bet you they're not even making money. Yeah, see. Again, there could be valid reasons for a net loss. So if we look at the price to cash flow, okay, this is at 27. Look at the industry. So if I compare that to Apple, look at that, 14 or most. You can see it. Look at that. That's how much cash they're bringing in this latest quarter. Look at that, because that number dropped. So when the number drops, that means either your price went down or your cash flow went up. You saw that their stock price was going through the roof, and this ratio is going down. So they're bringing in a lot of cash, this company, Apple. A lot of cash. Again, it's good, probably one of the safer companies to invest in. And I know I'm getting off of earnings per share, but all these stats are important, and you can see how they tie in. It's just one comparison versus another. Now, their PEO ratio is interesting. See, when you see drastic changes like that, okay, this is probably due to Alibaba. So Yahoo, 12 months, 5.79. So if we look at their earnings per share, $1.57 over the last 4 quarters. And then the price to cash flow is even higher. Yeah, there's something really funky with these numbers. Look at that, 148. The 5-year price average, PE ratio. Who the hell is paying, that's gambling. But the higher the number, either you're expecting incredible growth or it's a warning flag. So this is the last couple days. Look at that. In one day, we're down 2%. Down 2%. Bottom line is, if the economy shrinks, right, and these companies, even if they're profitable, but their profits go down, their stock price is going to go down as well. But that's a whole nother story for another day. Why these prices are going up like this on certain companies that aren't really justifying that, or an average. It gives you a snapshot that you can compare from one time frame to another. And when you see something that is drastically different, like that one on Yahoo, that's a red flag, and it's either an opportunity or it's a warning. And that's where you have to look into it and determine if it's one or the other. Like oil, there's a good, if you think that the economy is going to bounce back and that oil's prices are going, net incomes are going to go up, because eventually it will. It just might take a few years.